Hey everyone, it's Wolfgang. This video is about the Fed can lower mortgage rates now if they wanted to. Before I get started, this is not a paid endorsement. Celestial Seasonings, they have nothing. I have nothing to do with them. I just want to recommend this tea that I've been using for a number of years. It's a great stress reducer. It gives a really calm feeling. It's called Tension Tamer by Celestial Seasonings. There's no caffeine. It's got B vitamins. It's got herbs in it, and it gives you a really calm sense of well-being after you've had a cup of it. So if you have a high-stress job, or if you have a business and you have stress or in your personal life, check this out. You can buy this at almost any supermarket. You can also buy it online. It's a great tea, and the quality is good. It's a very reliable. After you drink it, it's a very calm feeling. Doesn't make you sleepy though. Okay, so on with the video. So a lot of people have been wondering why people are up in arms that the Fed will not lower interest rates. Other people don't think the Fed has the capability to lower mortgage interest rates. And why are mortgage interest rates such a big deal anyways? People wonder. I'm going to explain all of that. So if you've heard people talk about the Fed and you wonder, why is everybody so fixated on why the Fed is not lowering rates? After you watch the entire video, you will definitely know why people are concerned about it. Okay. The bottom line is we're dealing with some incompetence in the Bureau of Labor Statistics and in the Federal Reserve. And a lot of people know that, and that's why they're upset about it. So, but let me start by giving a background on how the Federal Reserve controls interest rates, because that will tell you all you need to know about the state of the job market and the state of the housing market, which is in bad shape. Okay, to start with, there are two interest rates. There are short-term interest rates. There are long-term interest rates. The short-term interest rates, this is the interest rate that all of us kind of know, we become aware of because we hear it being discussed all the time. The short-term interest rate, the Fed adjusts that by setting the prime rate, the interbank lending rate, the Fed funds rate. The prime rate is the short-term interest rates in our economy. The Fed sets it directly. It affects credit card interest rates. It affects the interest rates on personal loans that are variable. It affects short-term business loans. So the Fed can directly set the prime rate, and it will affect credit card interest, personal loan interest, business loan interest. The second type of interest rate, long-term interest rates. That's where mortgage interest comes into play. Why do we need mortgage interest rates to be at the right level? Because it stimulates jobs. When someone buys or sells a home, they hire a lot of people. Landscapers, painters, plumbers, electricians, remodelers, people who install kitchen cabinets, people who sell furniture, roofers, all the tradespeople. It creates a lot of jobs. The housing market creates a ton of jobs in our economy. So here's the background on the 30-year mortgage rate and why that needs to be at the right level for our economy to be healthy. Okay, so the Fed can directly control the long-term rate, the mortgage interest rates. That's what a lot of people don't know. A lot of people are unaware that the Federal Reserve can directly control mortgage interest rates. I will explain how they do it. It's really simple. If the Fed buys the 10-year Treasury bonds on the open market in a large quantity, that will increase the price of the bond, and it will lower the bond's interest rates. Mortgage rates are tied to the 10-year interest rate. So if the Fed buys a lot of 10-year bonds, it lowers mortgage interest rates. That's how it's done. If the Fed wants to lower mortgage rates, they can do it right now by buying a lot of 10-year bonds. I'm going to give you more than one example in just a few seconds here of when the Fed actually did that to lower mortgage interest rates dramatically to help the economy. So just a little more explanation on this, how this works, the mechanics of it, okay? If the Fed buys the 10-year Treasury bonds in large quantity on the open market, that will drive up the price of the bonds. Why? Okay, supply and demand is why. Let's say that you live in a small town in Illinois and oil is discovered. What would happen to the price of homes and land if oil was discovered there? They would shoot up. Tons of people would start buying land and would start buying homes in that area if oil was discovered. An increase in demand, when people start buying things, it drives up the price. Okay, the way bonds work, if you start buying bonds, just like anything else, it will drive up the price of the bond. Buy a lot of bonds, price goes up. If the Fed buys the 10-year Treasury bonds in bulk, in large quantities, the 10-year bond price will go up. And that will lower interest rates, because with bonds, the interest rate moves in the opposite direction to the bond price. If the bond price increases, the bond interest falls. So here's how the Fed can lower mortgage interest rates. Really simple. Buy a ton of 10-year Treasury bonds on Monday. Monday morning, the Fed wakes up, Jerome Powell says, buy all the 10-year Treasury bonds in sight. We're going to drop mortgage interest rates down to 1%. They could do that on Monday morning. So that would help the housing market. If the mortgage interest rate dropped below the current level, there would be a lot more jobs for flooring installers, landscapers, painters, remodelers, sellers of kitchen cabinets, sellers of appliances, roofers, electricians, plumbers. All the trades would have suddenly a lot more work. So that's why it's important. So now I'm going to give you two examples from recent times that the Fed lowered mortgage rates dramatically to increase the number of jobs. 2008 housing crash. The Fed bought lots of 10-year Treasury bonds. What does that cause? As I said, when the Fed buys the 10-year Treasury bonds, mortgage interest rates drop. Mortgage interest rate fell to 3.7% because the Fed started buying lots of 10-year Treasury bonds because of the 2008 housing crash. Why did the Fed buy lots of 10-year Treasuries and lower mortgage interest rates? Because there was almost 2 years worth of unsold homes. 21.8 months supply of unsold homes. Normally, there's 5 months supply of unsold homes in the economies. This is like more than 4 times that amount. The economy was in bad shape. So the Fed bought lots of 10-year Treasury bonds in 2008, forced the mortgage interest down to 3.7% to encourage people, here's cheap mortgage debt. Please take out a loan and buy these homes. We've got way too many homes. Mortgage interest is now cheap. Go ahead and take out a loan, buy a home. That worked. It took many years, but all those homes eventually got bought out. All right, so 2020, in more recent times, the COVID crash was caused by when the government shut down the economy, forced a lot of businesses to close. At that point, we had almost a full year supply of unsold homes. When the government shut down the economy, the Fed again bought 10-year bonds, Treasury bonds. Mortgage rates were driven down to only 2.7%. Now, just remember, back in the housing crash days, the Fed bought 10-year bonds and drove mortgage interest down to 3.7%. In the COVID crash, they drove the mortgage interest even lower. And I have to tell you something. When we did a refinance on one of the properties we own, I think it was in 2021 or so, that time frame, we were looking at 2% to 2.5% mortgage rates. So mortgage interest rates got even lower. But on average, when the Fed started buying 10-year bonds, they drove the average mortgage rate down to 2.7%. All right. So just to recap, 2 occasions when the economy got into trouble, when there were too much of a supply of unsold homes, and they bought the 10-year bonds and drove down the mortgage interest rates. So I want to say something about the month's supply of unsold homes. What does it mean? What it means is at the rate people are currently buying homes in the economy, it will take X number of months to buy all the homes that are unsold. In 2008, at the rate people were buying homes, it would have taken almost 2 years to buy up all the unsold homes. 21.8 months supply means at the current rate people are buying, it will take 21.8 months to buy all the homes that are available. In 2020, at the rate people were buying homes, there was an 11.9 months supply of unsold new and existing homes. At the rate people were buying homes at that time, it would have taken almost a full year to buy up all the unsold homes. Normally, we have 5 months of supply of homes. That's the average. Now, if you're in an area where people are moving to, the number of months supply of homes can drop to almost nothing. In recent times, there have been parts of the country where a home would go on the market and have multiple offers on the first day and be sold by the end of the week or within a day or two. And so that's a 0 month supply. But on average, it's 5 months. So when the Fed saw this, 21.8 months of unsold homes, almost a year of unsold homes, bam, dropped the mortgage to 3.7% by buying 10-year treasuries. Bam, dropped the mortgage interest rate to 2.7% by buying 10-year bonds. Okay, so what is the current situation? 13.8 months supply of unsold homes. That's even more than in 2020. 2020, about a year's worth, 11.9 months. Now we have 13.8 months of unsold homes. Should we have 2.7% mortgage rates? Because we did in 2020. Why not now? We have 7% mortgage rates. And what the financial media is not telling people is what I'm telling you now. The Fed can easily, on Monday morning, they can lower mortgage rates now. Jerome Powell can tell the Federal Reserve people, go to the open market and buy the 10-year treasury and drive mortgage interest rates down to 2.7%. We have over a year's supply of unsold homes, and it's not happening. Okay? So the reason people believe that Jerome Powell is incompetent is because of these 2 cases. There were different people running the Federal Reserve at this time and the Bureau of Labor Statistics. But right now, the Bureau of Labor Statistics and the Federal Reserve has incompetent people in charge in those institutions. I'll explain that in a couple seconds here. But people are not happy because they know, people who understand what I just explained, they know the Fed has the ability to do this, and it's not happening. So what's the big deal if there's 13.8 months supply of unsold homes? I will tell you. People who install flooring have fewer job options. People who do landscaping, painters, remodelers, people who sell kitchen cabinets, people who sell appliances, people who do flooring, roofers, remodeling companies have fewer jobs. And, the important thing for me personally is being humane to all of our fellow citizens. Anyone who wants a job so they can feed themselves, and if they need to, if they have a family, feed their family. That's the main thing I care about. I want this fixed so that people who want to work and need to work have the opportunity to. Because right now, this is ridiculous. This is incompetency. This is an incompetent, these are incompetent people in charge. So I want to say something about the Bureau of Labor Statistics. Because as I mentioned in, I believe, yesterday's video, the Federal Reserve, Jerome Powell, he's relying on the Bureau of Labor Statistics report on jobs to provide cover to keep rates high like this. Jerome Powell is saying, I cannot lower interest rates below this because the Bureau of Labor Statistics is telling me employment scene is good. It's not good. Most of us know that. The number of long-term unemployed people right now is the highest it's been in many years. Long-term unemployment, these are people who have been out of work for far too long, many weeks, and they can't find work. So the Bureau of Labor Statistics is providing cover for Jerome Powell to be incompetent. This is incompetent. We know what the mortgage rate should be when there's a huge supply of homes unsold. It's killing all those home-related jobs. This was killing a lot of jobs in the economy in 2020. What needs to happen is there needs to be some action in the government to apply scrutiny to who in the Bureau of Labor Statistics is presenting what we believe is manipulated data to provide cover to Jerome Powell to keep mortgage rates too high. We have almost a 14-month supply of unsold homes. The normal rate's 5 months. And in some markets, it can be driven down to like a month or two. Not now. Mortgage rates are too high. So the most important thing is we need people to be able to work if they need work. If you can't find a job, it creates desperate times in people's homes. It creates a personal conflict inside people's homes. So to be humane to our fellow citizens, we need competent people in these jobs, Bureau of Labor Statistics and Federal Reserve. This needs to be addressed. This is not good. So what I laid out here, I showed you how the Federal Reserve has direct control over mortgage interest rates. They can, if they want to, on Monday morning, start driving down mortgage interest rates by buying the 10-year Treasury bond. And they're not doing it. And I don't think they will. As far as the politics behind it, I don't really care too much about the politics. What I care about is being humane to all of our fellow citizens, people who want jobs and are not able to get work. Because, when we've got this many homes sitting unsold, there's a lot of people who are not getting work because of that. And it shouldn't be that way. And we know the Fed was cognizant of this problem, the fact that it puts a lot of people out of work when there's too many homes for sale. The Fed in the past was cognizant of this issue, and they dropped interest rates, mortgage interest rates, by buying the 10-year Treasury in bulk. In 2020, they dropped mortgage rates to 2.7%. In 2008, the housing crash, they dropped mortgage interest rates to 3.7%. They have the power, and they're not using it. And so now you know why there are so many people who are applying scrutiny. They're scrutinizing the Fed and saying they're not doing their job, because they aren't. This is improper. This is incompetence. If this was a school project, you'd get an F. This is an F. And Jerome Powell's not an economist. He's a lawyer. That might have something to do with it. I don't know. If you have any questions about this, I'd be happy to answer any questions that you post in the comments. Again, this is, for me personally, this is about being humane to people, giving them the chance to feed themselves and their families, to be able to work, because they need to work. They need to be able to have the opportunity to work. And it could be better. And that's what I'm most concerned about. So please ask any questions, and I'll answer them if you post in the comments. I really want to thank everyone for watching, and have a great day.